They say that March comes in like a lion and goes out like a lamb. Well, this month has been a wild ride in the stock market and in the bond market. Lots to share with you this month. I'm Dean Barber, founder and CEO of Barber Financial Group. Stick around for great information on what's happening in the economy and the markets. Welcome to the monthly economic update. I'm Dean Barber, founder and CEO of Barber Financial Group. All right, March was a crazy month. Let's take a quick look, first of all, at what the major indexes did in the month of March, and then we'll take a step back and see where are these major indexes year to date. Let's start out with a month look. We can see that the Dow Jones Industrial Average was our winner for the month of March, up 7.18%. And that was followed by the equal weight RSP, 5.39%, S&P 500 higher by 4% in the month of March. We go down to the bottom here, and the Russell 2000, the IWM, is actually negative for the month of March by 1.79%. So everything started off pretty decent in the month of March, but let's take and then we had a little bit of a pullback. And we're going to talk about why that pullback occurred, and we're going to talk about the 10-year Treasury and what's going on with bonds. And we're also going to talk a little bit about money velocity. So let's first start by going back on a year-to-date look at these major indices. And what we see is that the worst performer for the month of March is still by far the best performer for the for a year-to-date. I'm sorry, you got small caps. The S&P 500 small cap sector up almost 16% year to date. Mid cap 400 up 11.86, and then the Russell 2000 9.35. It's interesting if you look at the Dow Jones Industrial Average up 8.46% year to date, and it was up almost a little over 7% just for the month of March. So most of the gains in the Dow came in the month of March. S&P 500 positive by 5.86%, and remember, S&P 500 was up a little over 4% in the month of March alone. So are we starting to see a little bit of a shift away from small cap and back to large cap again? I don't think it's happening yet. This is a pretty short time frame to judge that by. We are watching that very closely, and as needed, we can overweight or underweight into the sectors that we need to be in to make sure that we're catching what's going on. I want to turn our attention to bond funds here, or bonds in general. All right, so as of the recording of this, we have the 10-year Treasury yield at 1.77%. Remember, the 10-year Treasury yield started at 1%. It's interesting that that's happening because the Federal Reserve has said that they plan to keep interest rates where they are with no changes all the way through 2022. But this rise in the 10-year Treasury has absolutely killed the TLT. Now, the TLT is an ETF that mirrors the 20-year Treasury. And take a look at this, down 13.89% year to date. AGG is the bond aggregate, down 3.47% year to date. So those are in stark contrast to what's happening in the equity markets. Now, this rising interest rate environment and how much we've seen it rise so much in the last month has been part of the cause for the volatility that we've seen in the stock market. This top line here, the positive 2.27% year to date, is a fund that invests in mortgage-backed securities and senior secured debt. So the mortgage-backed security ETFs and mutual funds, they're not all created equal, so they haven't all done the same things. But that's an area that the rising interest rate environment shouldn't affect nearly as much as the AGG or the TLT. So when we're looking at bonds within your portfolio, obviously we still think AGG has a place in there. I think the TLT is way too risky right now, but I also think that we need to be thinking about adding some floating rate and some mortgage-backed securities. So what's going on with interest rates? Why are they rising? Is inflation really coming? Well, let's look at inflation from a little bit different perspective. When we understand how inflation is actually measured and what causes inflation, and you've heard me tell this story before, we're going to go back to money velocity. So money velocity is simply defined as how many times per year does a dollar change hands. Now, the chart that I've got up here runs us all the way back to 1959. And so you can see here in Q1 of 1959, a dollar was changing hands on average 1.773 times per year. And that stayed fairly benign through the 60s. And then in the 70s, velocity started picking up, and into the 80s, velocity picked up and actually peaked out here in Q3 of 1997, where the dollar was changing hands an average of 2.192 times per year. Then we go to a declining money velocity. Pre-COVID, back here in Q4 2018, money was changing hands at 1.463 times per year. COVID hits and money velocity drops through the floor. And we now have money velocity, which means money changing hands at an average of 1.148 times per year. So this fear of inflation coming roaring back because of all of the stimulus money, it can't happen until money velocity picks up. So the risk is, if money velocity picks up, and say we even get back to where we were pre-COVID, that could definitely cause some inflation. But let me reiterate that the Federal Reserve has said that they don't really see inflation being a risk in the short term, and that being the next couple of years. And they have committed to this zero interest rate policy through 2022. Time will tell. And there's a lot of people that are saying this spike in the 10-year Treasury is going to be short-lived, that it'll come back, that they don't think that the economy is going to be as strong as what they think it is. We still don't know what's going to happen with COVID. There's rising cases out there again. And so a lot is unknown. And I think that what that means is we're going to continue to see volatility here for the next couple of months in the stock market. We're going to continue to see volatility and some pressure in the bond market. What I want you to keep in mind is that your portfolio should be designed to allow you to achieve your short, your intermediate, and your long-term financial goals. I always encourage you to stay in touch with your advisors here at Barber Financial Group. Keep those lines of communication going. Ask us the questions, review your plans with us, and just stay in touch so that we can make sure that we can help you live your one best financial life. Thanks for taking time to join me for this monthly economic update. I'm Dean Barber, founder and CEO of Barber Financial Group. If you're joining us on YouTube, make sure and give us a thumbs up and subscribe to our YouTube channel. And if you weren't aware, we also have a YouTube channel for the Guided Retirement Show. Look for the Guided Retirement Show on YouTube or on your favorite podcast app.